get into trading and trading revenue and the research. And the regulatory environment, which may have been well-intentioned because you had analysts that did a lot of really bad things, has basically made it such that analysts can't make any money covering small stocks anymore. And brokerage firms, as a result, can't do that. And so you're right, it's better to be the 38th guy talking about Intel than to be the second person talking about some hot, small growth company. And we have bought ourselves the market that we have, whether we like it or not, for a whole variety of reasons.
But that's the main point that I've tried to make, is that companies can't depend on the structure in the market, which no longer exists, like analysts continuing to cover smaller stocks. It's not going to ever come back. You're right, you're not going to see that. However, companies can be more active in creating direct communication. So in lieu of an analyst giving the information on the stock, a company can have a direct communication with a potential good buyer and have exactly the same result.
I don't think they can have the same results. You used to have analysts that could literally pick up the phone, talk to their sales force, and then across the globe, institutional buyers were getting information. And they were talking about stocks every day, and some of them were doing a great job, and some of them were doing really bad stuff. Like telling you to buy on one hand and telling you on the other hand the company was really a bad company.
But you can still communicate.
But you cannot touch the distribution and the amount of dollars that those brokerage firms used to be able to get to.
But we have things like internet and social networks that allow us different forms. I mean, just like you have a new model that has a totally different distribution, a totally different network.
Mm-hmm. And that's what we're going to try to replace. We're going to try to get that kind of liquidity into the market.
So we're never going to go back to the old foundation, but there are going to be new solutions. We need to create new structures that are aligned along the proper incentives. And the ultimate thing at the end is about growing real companies, because that's how you grow an economy. And that's how you grow innovation, and you keep America as a leader, worldwide. And, I don't think there is a big disconnect between the fact that the IPO market is broken in the way of funding and supporting the companies that are creating the jobs, in the country, is broken, and the fact that the economy isn't, working, and there's, huge unemployment on the other end. There is a direct line. You can connect the dots directly.
You could argue the IPO market's not broken. It works for really big companies and smaller companies. I mean, there's a lot of different ways to look at it.
The small companies are the ones creating the jobs. 90% of all job growth happens historically after an IPO. If there's no IPOs and we're not supporting our companies properly, you're not going to have the job growth. You're going to have exactly.
There's other sources of liquidity. I guess all I'm saying is what we should do is find other sources of liquidity for great businesses, whether they're $2 million of revenue or $2 billion of revenue. We don't have to just rely on the public markets. I think there's other ways to do it.
And other sources of marketing. We can't depend necessarily on analysts continuing to cover small stocks. And if I may, I'd love for someone to hand a microphone to my friend, because I'd like to introduce another source of capital. So my friend Erica Martin is here from TA Associates. So, which is one of the largest private equity firms in the world.
A couple of questions.
Sure, I would love to come back to you, but I'd just love for her to say just one or two sentences, if you don't mind, Erica, about, in addition to IPOs and private markets, that, some of the growth companies in our audience might, want to consider, a private equity firm as not an opportunity for an exit, but I know you've told me you like to invest in teams and providing fundings to good teams, for growth capital for the companies.
Yeah, I think we probably fit in best with the gentleman who made the comment about dumb money. I think, well, no, I think if you're looking for private investment, perhaps you want to be public, but maybe now's not the right time, whether it's the market's not being, not acting appropriately or well, or maybe you just haven't reached that size yet. I think growth private equity fund can often kind of come in and take that company to the next stage that maybe has already reached a late stage for a VC fund. And be value add and help you expand in international markets and products with our own network and with acquisitions. And then you can still go public. We've taken hundreds of companies public over the past 40 years. We've been doing this for a long time. And so there is that opportunity to get a lot of liquidity with a value add partner and still go public.
And so what's the size deals you'd like to invest?
For us, we're looking to do deals from the $60 million to $500 million range. But there are growth private equity funds across the board.
Thank you. So there's another opportunity for you to grow your companies. Any more questions?
Sure.
Thank you, Erica.
Mike is good. You've got 5 more minutes.
Okay.
I had 2 questions. One was, I'm assuming these are all Regulation D offerings on something like a non-public exchange. The other question is, what do you think SEC regulations regarding hedge fund registration will have has an impact on your market?
They don't all have to be Reg D offerings, there can be 144 offerings as well. And I don't have an opinion on that, I just don't have an opinion on the hedge fund business.
My question's sort of based on a couple of assumptions and hypotheticals. Just out of curiosity, obviously the IPO market was running really strong for a while, and it's definitely quieter now. When I've seen some other presentations about Indian companies, there's a ton of public companies, and I've asked them many times, why is there so many more public companies? And the answer I've gotten from many is, well, that was the real good way to access capital in India. They didn't have the mature financial markets that exist here in the Americas. So assuming that maybe the IPO market is a reflection of maybe maturing of access to capital, how does that affect the economics as a VC firm? Does that change the model substantially? Does that change your horizon of investment? What does that do for you guys?
I'm sorry, can you clarify? So you're asking whether or not the presence of a mature IPO market?
If the IPO market doesn't get substantially larger from where it is now, say it grows but it doesn't ever touch where it used to be, it's something in between, what does that do for, obviously we talked about the VC firms looking for that pop in the markets, but if they're not going to get it but from a very few late stage companies, how does that work for you guys?
I think it's a great question. If you look at how capital has flowed in the venture industry, my firm GGV, we were founded on the principle 10.5 years ago of investing in both the U.S. and in China. And in 2000, being in China was a very risky, unique strategy. Today, most firms with whom we compete in the U.S. up and down Sand Hill Road are also in China. We think we have some advantages there, but capital's flowing to high growth. The same is happening in India. There's lots of traditional Silicon Valley firms and local firms that have raised pools of capital to go after India. I'm seeing more and more of that in Brazil, and I think we'll just continue to see capital flow to high growth economies that are open to, where the laws support companies forming and ultimately, creating value. So, as long as there's growth out there, there's going to be venture capital chasing that growth. And what the exits look like, I think, the presence of a strong IPO market here in the U.S. or lack thereof will have some impact on our business short run. But there are going to be markets that develop outside the U.S. as well, because capital is just going to keep trying to flow to high growth companies. That won't change, and so I don't know if we have. Maybe it is bad regulation. I don't know enough to know why the IPO market isn't stronger here these days, but it'll be strong somewhere. Capital will go find those companies.
I'll just add, by the way, that in terms of the deals, the VC-backed deals, there's a huge preponderance of those deals done by probably no more than 15 companies. I mean, we could all name them. So it seems to be a contraction taking place in the VC community. You could be a nice VC company and get a few deals, but if you take a look at, say, the solar industry, which is hugely capital intensive, there's only so many VC players that can play in that field. You've seen sort of folks like Mike Maples and the Ron Conways of the world, these things, that sort of super angel guys that are now raising funds, and seems to be sort of a contraction taking place that you don't have a lot of the VC guys that are in the middle. You have the huge Sequoias and the Kleiners and whatnot of the world, and then the guys that used to be in the middle just aren't around. We just don't see those guys in terms of the VC-backed deals that we see going public. It's a who's who. It's Benchmark, Greylock, Sequoia, and
GGV.
that's right. That's right. Exactly.
Yeah, and that's a great question, and I'll just add that part of the life cycle as the industry has matured. I think the growth of the micro VCs or super angels, has come about also because of the lack of exits on the top level. There's less returns. A lot of funds weren't able to raise a continuing fund, so about half the firms disappeared again if they weren't producing returns at that level, which IPOs help do. You need a grand slam home run every once in a while to win that ball game.
contraction of the smaller VC firms, I guess, relating that to the original introductory slide you had about the size of the IPO, what is the correlation, I guess? I mean, clearly the fact that
Yes.
there's a lot of money being pumped, so the IPO size has to be bigger and only being handled by the Kleiners and the.
Right, and then we know that you have to, the economics of the firms, taking companies public, needs a larger deal size. We know that in order for analysts to give you coverage, you need a larger deal size. So it's like the public markets have become so skewed towards the success of large companies. So VCs are starting to choose, only, companies, a lot of, consumer brands and so on that can become very, very large and, have tremendous growth so that they can function in a healthy way in the public market. So there are still some very good deals that could eventually grow into, potentially companies like a Siebel or so on, but they're not gonna see the light of day if they can't.
What I'm trying to clarify is the chicken and egg. What is driving what, right? Is it the contraction of the VC firm driving the size of the IPO, or the size of the IPO driving the contraction?
I would say it's the size of the IPO that's doing it, yes.
So many more things like it's just.
Right, and it was a perfect storm. Yeah, that's why, the last slide I showed with there was these multiple things all happening simultaneously. They weren't necessarily correlated, but the extra regulations coming on top of, the whole internet bubble fears, all of it kind of coming all at the same time, and it just drove that IPO bar so high. So now we have to find a way to survive, that longer time frame to get.
So I wanted to kind of be running out of time, so wrap it up. One quick question that we wanted to allude to is, you mentioned options of capital that goes beyond public markets and these private stock markets. We didn't hit upon the M&A option, the whole sort of organic option of exiting, right? So could the panel sort of chime in on that, and that'll set up our next panel pretty nicely. So again, thanks for taking the question.
I would say, great point. We talked a lot about IPOs and others. M&A continues to be the primary source of exit for private companies. If you look at, all the large tech acquirers have continued to get bigger, and if you look at their operating income of, call it the top 10, Oracle generates over $1 billion in cash a quarter. You look at, those are the kind of numbers you're looking at in terms of these acquirers. And so, while they are disciplined and they have, I would say they're probably more disciplined than some of the public investors. M&A continues to be a common exit, and we do find clients that look at both IPO and M&A in a dual track process. What can often happen is when you file your first when you file the initial S1, a lot more information about your company is now public, and I guarantee you the 10 acquirers you think that could potentially buy your company will all read your S1 cover to cover, and then we'll probably call you if they're interested in acquiring you.
How does going public affect your valuation for potential M&A? Especially in the context of Pandora, for example, would you hazard to guess whether their valuation would be better if they'd actually been, setting up for a sale instead of going public?
Yeah, I probably can't comment on Pandora, given where we are from, given these were issued and given the quiet period and so forth. But I'll give you the broader answer to that, which I think is, markets each market kind of defines valuation, right? It's always about comparative, it's about relative value in most cases of valuing IPOs. And so, when you take a company public, you're comped against, pick your, 3 or 5 comparable companies that are appropriate where they trade, and that helps to guide buy-side investors and what they will ultimately pay for you. M&A is a very different animal, right? There's that piece of that, of how you think about value, but, if you're a company X and you're getting bought by HP, who could take your product and deploy it against its thousands of customers and drive 20 billion of synergies. I mean, I can give you an extreme example, but they're able to pay a higher price than a public company, than a public investor might in an IPO process, right? So it really is. It's not a one-size-fits-all. M&A gives you better value than IPO. IPO gives you better value than M&A. It really is unique to the type of business you are and who the acquirer is going to be.
And I will also say that's another opportunity to enhance and grow and improve, because a lot of M&As actually fail, because it's about cultures and personalities. So there's a lot of room for value, but you have to be careful also that there's a really good fit. So there's some statistics on that, and there's companies that are actually actively investing. So whereas the IPO market, is broken, so there's opportunities for private trading markets to evolve. I think there's now opportunities for people to help M&As improve and hold their value and really fulfill their promise.
I think the option of going public drives up your M&A value. Just because you can be sold, I don't think it affects your IPO price. The Fidelity portfolio manager doesn't sit there and say, I better buy this IPOs, otherwise they're gonna get sold. But the HP corporate development person surely says, I better buy this company, because otherwise they're gonna go public, and then it's gonna trade up, and I'm gonna pay a much bigger price.